So, but another interesting thing to ponder here, and again, you've seen this vast, you've gone through so many cycles and so many things with central banking and economies. It's not quite 10 years, but we're coming up on a decade since the financial crisis started economies and financial systems unraveling, and then central banks jumped in with super aggressive rate cuts, and then all these unprecedented measures. Here we are, and they're trying to make a big shift, but they're having trouble. Why?
Well, the fact is that indeed about a decade ago, when the mega crisis broke out, there was a great consensus of what needs to be done. And all central banks together have lowered their interest rates to unprecedented low levels. Fiscal policies got expansionary all over the world, and the objective was to prevent a calamity. And it was successful. Interest rates remained low, QE has been expanding, and etc. We are now in 2017. I want you to imagine, is there a single central banker who a decade ago believed that when we meet here in Jackson Hole in 2017, this will be the subject, that interest rates will be still so low, that quantitative easing will be still so expansionary? So the fact of the matter is that this has taken much longer than everyone expected. It was successful, but like every policies, there is diminishing returns. And with the passage of time, as real interest rates became negative for such a long period of time, practically all over the world.
But Jacob, wouldn't most central bankers not think that, oh my gosh, low interest rates, these extraordinary tools, unemployment's falling, Japan record low rate, et cetera, that inflation would be so stubbornly uncooperative, that it would be lower than central banks want it to be, far from target? Would they have expected that? And isn't that the big, big conundrum now?
They have not expected it, and it is still a puzzle to many, but we need to remember one important thing. Other things happen in the background. While you are only watching the inflation and you are saying we are still not there, let's not restore yet normalcy, in the meanwhile, a lot of negative consequences, unintended, are happening in the background. When interest rates are so low and negative in many cases, investors are looking for alternatives. They are chasing after returns, and with it, high risk. Corporations are buying back their shares instead of investing in plant and equipment. There is a disconnect between the real and the financial sector. There is a danger of the creation of bubbles. And all in all, when we are sitting here, we are first puzzled about the low inflation, but we are also puzzled about the low productivity and somewhat subpar growth. And the question is, aren't they interrelated?
In what way? How are they interrelated?
Is there a possibility that the low productivity that we have is in part a consequence of the fact that investments are being put in the financial sector rather than in the real economy? Is it part of the fact that the interest-sensitive sectors like housing have been encouraged, and those happen to be the low productivity sectors? We still have a puzzle, but I really want only to urge to say that inflation is not and should not be the only gauge for monetary policy, because suppose that I told you that inflation we will not be able to raise it to 2%.
Some people
is
think
this a license to continue and continue and continue with the low rates and with the easy monetary policy? Nobody would say that. So I would only say, and I believe that that's the reason why the Fed has already started in its normalization, and I strongly encourage it, and I think it's good news. The Fed that has been so prudent for so many years, if it starts now and continues in raising rates and in dealing with the balance sheets, the markets will see this as a very positive signal.
Okay.